Hello and welcome to the Entrefluential Life's special edition Peninsula of Paradise Financial Planning Workshop for Florida homeowners. I'm John Tanner, and today we're going to break down what home equity is, why it matters, and how you can use it wisely as a Florida homeowner. For those of you who don't know me yet, I'm a business strategist, a licensed real estate broker, and a former certified residential real estate appraiser and mortgage broker. I've spent more than 3 decades in the real estate valuation and mortgage finance industries. In that time, I've helped thousands of families buy, sell, appraise, and or finance their homes across the country. And I've appraised properties in 13 counties across Florida. I was also briefly licensed as an appraiser in Georgia and Texas prior to the Great Recession. This series, I should probably say this too. I also studied hotel development in grad school, and I have a law degree where I specialized in residential and commercial real estate law. So I have a little bit of background in real estate across a wide variety of different segments. So this series here is designed to give you some straight talk and insider knowledge so that you can make smarter decisions with your most valuable asset, your home. So let's start at the beginning. What exactly is home equity? The definition is simple. Equity is the difference between what your home is worth and what you owe on it. Here's the formula. Home value minus mortgage balance equals equity. If your home is worth $350,000 and you owe $200,000, then you've got $150,000 in equity. Let's see how that looks. I thought I had a slide for that one. Let's go here. There it is. $350,000 minus $200,000 equals $150,000 of available equity. All right. So, with that in mind, equity is important because it builds your wealth, your family wealth over time, which is why 90% of all millionaires made their fortunes with real estate investments. It's like the best savings account that you can have because it grows as your home's value increases or your investment property value increases, and it keeps building up more value because of the buy down of the mortgage loan amount that you're paying over time, whether it be you paying your home mortgage or renters paying your mortgage on your investment property. Or let's say that you own a business and you're paying money on a piece of property that you bought to house your business. Well, the customers that are coming in and doing business with you, whether it be that you're selling products or services, that money that comes into the business is paying for your mortgage. It's paying off that loan so that at one point in the future, if you have a 15-year mortgage or a 30-year mortgage, that loan is going to be paid off, and now you have this bank account, basically, which is your home equity or your business equity. So equity is important because it builds your wealth over time, and it's like a savings account that grows as your property value increases and your mortgage buy down decreases. The best part is that you can tap into that equity to reach your financial goals, whether that be to renovate your property or to consolidate debt or to support your family. Equity gives you financial flexibility. Now, there's 3 different tools that homeowners can use to unlock the equity. Option 1 is a home equity loan or a second mortgage. You get a lump sum of money and you repay that loan in fixed monthly payments in addition to your main mortgage payment. So you essentially have a first and a second mortgage. I've had that myself. I had a first and a second mortgage on the purchase of my home back in Miami, and both payments totaled just under $2,000 a month back in 2005. I think I sold it for $280,000 back then, which was a huge mistake because I just checked on Zillow. I looked at the Zestimate today, and it's worth $557,000 according to the Zestimate. So if I would have kept on it, I would be sitting on almost $300,000 in additional equity today. A quarter of $1,000,000. Insane, right? And just that was in 2005. We're in 25. So 20 years later, $300,000 richer just by sitting on a piece of property, right? It's insane. Not even to let's not discount the fact that I could be making monthly cash flow by renting it out, probably at $3,000 a month today. I don't know what the rentals are over there, but probably. So it was a four bedroom property, a duplex. It had a efficiency on the side. All right. Anyways, option number 2 is a home equity line of credit, or what we call a HELOC in the business. And this works like a credit card that is collateralized by your house. So you can borrow money, you can pay down that debt and borrow again over and over. It's like an open line of credit. And you only pay interest on the loan amount that you use. The downside is if you default, the lender can foreclose on your home. And they usually get a subordination agreement from the primary lender, meaning that they get to be first in line at court to collect their money. So that's the risk that's involved there. Option number 3 is a cash out refinance. Now, this is a new loan that replaces your existing mortgage with a new loan for a higher amount. And you get to pocket the difference. That's why it's called a cash out refinance. So the difference is that you have to pay your loan origination fees for that loan. So if let's say that you cashed out $100,000, but your loan amount was your closing costs were $10,000, you would get a check for $90,000. The difference between 100,000 minus 10,000 of costs, which is loan origination fees. This option is frequently used for debt consolidation because you're going to take that money and pay off your bills, which is a great idea if you want to escape from the heavy weight of paying 20 to 30% interest rates on credit card debt. And you can buy it down, that same amount of debt, you buy it down to a 5 to 8% mortgage interest rate. So I'd rather pay, let's say, 8% interest on a new mortgage than pay 30% interest to the credit card companies. Or you can use the money for large expenses. Like, let's say you want to fund your business expansion. You're going to go buy a second property, right? Which is acquisition entrepreneurship. You're going to go buy a second location. Let's say you own a yoga studio and it's doing fantastic in Miami, and you want to open up a second yoga studio in Orlando, Florida. Well, you can use the cash out refinance to fund the business expansion, to make that purchase of that second location. Or you could use it for something personal, like maybe your daughter's wedding. Or maybe you want to add an in-ground pool to your house so that you can create your own island oasis. You have a lot of options available. Now, let's look at a real-world example. This is the numbers I showed you before. If you own a Florida home that's valued at $350,000 and your mortgage balance is $200,000, that means you as the homeowner have $150,000 in available home equity. The big question is, what's the smartest way to use it? Should you sit on it and let it accumulate over time, which is a great idea, or should you use it if you can use that money to invest in a business, or maybe reinvest it in the property? Again, like we mentioned before, you could pay off your high interest debt. You could fund some renovations like adding a pool. You have a lot of options. So when used wisely, your home equity can be life-changing. When used unwisely, you can burn it fast and live to regret it for decades. And trust me, I speak from firsthand experience because I've seen this in my own family several times. It can help you pay off high-interest credit card debt, or it can fund renovations that improve both your lifestyle and your property value, like the in-ground pool that I mentioned earlier. All right. It can support your kids' sports activities. Let's say that you have your children are involved in soccer teams and they have to travel. Well, you could fund those expenses with a HELOC, home equity line of credit, and you pay it down, and then you borrow more when the next season comes along. Or you could fund your children's college tuition, which can be leveraged by using a plan like the Florida 2+2 prepaid college plan, which you can tap into your equity to pay for. You're buying your children's college tuition at today's rates, so they don't have to pay the expensive cost that it will be in 15 to 20 years from now when they enter college. And it can even provide your startup capital for a small business launch. My caveat here is make sure that you have a really great business plan in place and that you've tested the idea in the marketplace before you spend that money, because once it's spent, it's gone, right? And the only way you're going to be able to recuperate it is if the business is successful. So long as it's successful, you can pay back your loan on the property that you borrowed against yourself, against your home equity, because that's your retirement capital. Think of it like that. It's your retirement capital. You're just making a loan to yourself. But if you have not tested your idea and you burn that money and the business fails, well, now you've lost your business activity and you've lost the equity in your property, and you're going to have to take time to build that value back up, which takes a lot of time. So just be frugal and prudent when you make those kind of business decisions regarding the tapping into the equity of your home. The key here is to make sure that you match your home equity use with a real, well thought out long term plan and goals, not just for a slush fund. So, here's where I want to caution you. Like I said before, I've seen people make big, big, big mistakes with their home equity. I met an appraiser once who used his equity to acquire two more investment properties. Then, when the market collapsed in 2008, he was overextended on his debt and he couldn't pay the mortgage notes for all three of the properties. And so he lost all three properties in foreclosure, his primary residence and his two investment properties. That's a cautionary tale right there. Some people just borrow too much, they overextend themselves on leverage and credit simply because the bank approved them for a loan, while others forget to account for the closing costs and the origination fees and the holding costs. And when I say holding costs, I mean you got to pay a mortgage payment on that loan. So you got to factor that in to what your income is and can you afford to pay those debts over a long period of time. So they don't just banks don't just loan you money. They charge you a fee for it. So you have to factor in what's the fee that they're going to charge you for it, and does it make sense to borrow that money considering how much you're going to have to pay to borrow the money from the bank, right? One of the biggest pitfalls is using equity without a repayment plan in place, essentially treating it like free money. It's not free money. If you're taking a loan against your property, the only way you're going to be able to settle that debt is to sell your home or pay off the mortgage payment. So you have to keep that in mind and treat it like it's a business plan. And as you have operating expenses, think about the second loan or the home equity line of credit as an operating expense and factor in that monthly payment so that you don't get uh, blindsided with that debt. We don't want it to turn into something that cripples you. It's supposed to be a tool that helps you. So don't treat it like free money. And finally, don't overlook analyzing your current credit status prior to filling out that online loan application. And here's why. Timing matters. If your credit isn't in good shape, then you could end up paying thousands of dollars more in compound interest payments because you got a 9% rate versus a 6% interest rate. So make sure that your credit is good. Generally, you want to have at least a 650 credit score before you take out that home equity loan or second mortgage or cash out refi. So now that we've discussed the opportunities and the threats of home equity loans, let's review 5 action steps that you can take today if you decide to move forward with a home equity loan. Step 1, check your home's current value. You can do so by visiting Zillow.com, or you can Google the word Zestimate, and that'll take you to the link where you can find out what your property value is worth. You have to type in your home address, and it'll give you an estimate. It's not precise, but it gives you a very good idea of what your home is worth today based on the sales comparison approach to market value, which is one of the 3 techniques under the principle of substitution. Step 2, find your mortgage balance. This should be pretty easy for you to do. You just have to look at your most recent mortgage statement. And step 3, deduct your mortgage balance from your Zestimate to derive at your current home equity position. Step 4, pull your credit score to see what your borrower's strength is. This will give you a good idea when you look at the marketplace of what your interest rate will be on a new home loan. And step 5, Match your goals with the right loan product, a second mortgage, a HELOC, or a cash out refinance. You've got to weigh your options and what the costs are for doing each type of loan. Remember, home equity is very powerful, but it's only useful if you align it with your bigger picture of your personal financial future. If you'd like to know about your true equity position, or if you want professional guidance on which option is right for you, then reach out to me directly at colemantanner.com, and I will be glad to discuss your options with you and connect you to one of our preferred lending partners. I would love to help you unlock your home's equity position wisely to ensure that you're making prudent financial decisions. Thanks for watching this special episode of The Entrefluential Life, and I'll see you inside of our next Peninsula of Paradise financial planning workshop video. Thanks, and bye for now.